Hello everyone. In this particular lesson, we are going to learn all about fiduciary funds. Okay, so what we need to know is fiduciary funds are to account for management's responsibility to manage other people's or other entities' assets. So these assets that are actually reported in these fiduciary funds do not actually belong to the government, but they certainly have that responsibility to manage them for somebody else. There are two types of fiduciary funds. We have custodial funds and we have trust funds. And the main difference between a custodial fund and a trust fund is really timing. Custodial funds is really quick, meaning cash comes in and cash goes out. So cash comes into the custodial fund and then pretty much immediately cash is going to go out. Basically what's happening is the government that is controlling the custodial fund is just a pass-through. They really don't have to make any decisions. They simply take the money on behalf of one party and distribute it to the party that it needs to go to. Versus a trust fund has a more long-term nature. There are various types of trust funds. We have investment trust funds, we have private purpose trust funds, and we also have pension trust funds. And as the names of the trust funds would make you believe, these are trusts for managing investments for somebody else, managing a private purpose for somebody else, and managing a pension for somebody else, most notably the current retirees and current employees of that particular government. Okay, so let's go through custodial funds first. The best example of a custodial fund is actually a property tax collector. For those of you that own a home, you know what I'm talking about. For those of you that don't own a home, let me explain how this works. When you do own a home, you get an annual property tax bill. And when you get the property tax bill, you will find out very quickly that you pay multiple governments. You actually pay more than just the city you live in or the county you live in. You're going to pay, and if you did live in a municipality, you're going to pay the city tax. You're also going to pay the county tax. You're also going to pay the county school tax. You might pay some special districts like a library or a transit authority. So you definitely pay a lot of different governments. This is what a tax bill is actually going to look like. And as you can see, and I'm just going to count them up here on the left-hand side, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. There are actually 11 different government jurisdictions that we pay a tax to. And basically the way the tax bill works is there is an independent property appraiser that appraises or assesses all of the property within the government boundaries. And the local government officials, elected officials, will actually vote on what's known as a millage rate. Millage rate basically is just a percentage rate. And so you take this millage rate, multiply it by what we call taxable value, and you wind up calculating what the tax should be for that particular jurisdiction. In this particular case, and just come all the way down to the bottom right, you can see for this particular property, the tax bill is $3,529.50. Now, logically speaking, the property owner is not going to write 11 different checks. That is not what we want to do, and there is no government that will allow the taxpayer to write 11 different checks. The taxpayer is going to write one check for $3,529.50 made payable to the county tax collector. The county tax collector, they don't own that money. They are simply going to take this check for $3,529.50 and they are going to deposit it in what is known as a custodial fund. And that custodial fund will then take that $3,529.50 and they will disperse it in the 11 places that it needs to go. So effectively what you see is that cash comes in to the custodial fund, and then that cash gets dispersed out of the custodial fund. And that county tax collector does not own that money. They simply have a fiduciary responsibility to manage that money and make sure it goes to the right place. Now, with that explained, let me show you some journal entries. So all of the property was assessed, all right, in the county, and the tax bills were prepared, using millage rates, just like I explained to you. And at the end of the day, the total taxes for all of the taxing jurisdictions within the county boundaries is $9,468,000. So the journal entry in the custodial fund is going to be as follows. The custodial fund is going to debit a receivable, and that receivable is basically the receivable from the taxpayers. They are going to collect that $9,468,000. And the credit goes to a liability due to all the other funds and the governments. Basically what they're saying is, yes, we're going to collect the $9,468,000 from the taxpayers, i.e. the receivable, and once we receive it, we are going to simply turn around and pass it along to all the government jurisdictions within the county boundaries, i.e. the liability. What you are going to see is a custodial fund has no operations. And what I mean by that is there's no operating statement. There's no revenues. There are no expenses. It's simply all on the balance sheet. And as a matter of fact, the only thing you are going to find on a custodial fund balance sheet at any given time is cash, receivables, and current liabilities. You're not going to find any equity, also called net position. You're not going to find it here. You're simply going to find cash, receivables, and liabilities at any given time. Okay, so $9,468,000, and in this blue box on the bottom of the slide, you can see the breakup of that $9,468,000. $10,000 to the state, $1,480,000 are county taxes, $5,060,000 are school district taxes, $2,552,000 are City of Washington taxes. That's the largest city in the county boundaries. And then, of course, we have little towns and cities. Ultimately, we would itemize this, but for presentation purposes, let's just throw it in one lump sum, $366,000. In any event, they add up to $9,468,000. Now let me show you something. What I'm going to do is I'm going to show you half of the taxes have been paid. So the state, if you remember on the prior slide, it was $10,000 was the tax levy. Let me go back. State, $10,000. Half of it was collected, or $5,000. Campbell County, $1,480,000. So half of that collected, $740,000. I think you get my point. So here is the 50% of the taxes collected, totaling $4,734,000. So the journal entry that the custodial fund is going to record is going to be a debit to cash because they received that amount, $4,734,000, and they're going to reduce the liability. Effectively, we've collected it from our taxpayers, $4,734,000. And then ultimately what's going to go on is the custodial fund is going to remit that $4,734,000 to where it needs to go. Now before I flip the slide, I need to explain some more items down here in the bottom blue rectangle. Now let me say this. You have probably all heard this saying before. Nothing in life is free. Have you all heard that before? Nothing in life is free. I know you have. And if you haven't, you're living under a rock. So basically, this is true with custodial funds as well. The custodial fund, which is most likely done with county employees, and the county tax collector is managing the custodial fund. Well, the county employees, they're basically not doing this from the goodness of their heart. They want to get paid. The county wants to get paid for what they're doing. They are giving all the resources. They're doing all the billing. They're hiring the employees. So the county tax collector, they're going to take a fee from all of the participating governments in this custodial fund. So as an example, the state, $5,000 was collected on their behalf, but what the county is going to charge is a 1% fee. So 1% of $5,000 is $50. So even though $5,000 was collected on behalf of the state, minus the $50 collection fee, the cash that's actually going to be distributed to the state will be $4,950. Skip the county for a second. Let's go to the school district. $2,530,000 was collected on behalf of the school district, minus a 1% fee of $25,300. So the cash that's going to be distributed to the school district is $2,504,700. You do the same thing for City of Washington and all the other governments. Now, do you notice that this middle column, the collection fee, it nets to zero? That's because the amounts withheld by all of the other governments total $39,940. Well, that $39,940 is going to be added to the county. So we collected $740,000 in county taxes, but in addition to the collection fee, they're going to get remitted $779,940. Take a look at the totals so you really understand this. $4,734,000 in taxes were collected, and $4,734,000 of taxes will be distributed to the various governments. The only difference is that we're going to take away from all the other governments and we're going to give that fee, that extra fee, to the county, because the county is the one doing the work. The county is the one that is managing the custodial fund. All right, hopefully you all understand that. Now what I'm going to do is I'm going to flip the slide and we're going to take a look at some journal entries for the school district. Take a look at the school district one more time. $2,530,000 in taxes were collected for the school district. $25,300 in a collection charge. And the net amount distributed to the school district, $2,504,700. All right, so here is the slide I wanted to show you. We are on the books and records no longer of the custodial fund, but the school district general fund. And so this blue box on the bottom, the blue rectangle, you remember these numbers from the prior slide? The taxes that were collected, $2,530,000, less the fee, the collection fee, equals the amount that is actually remitted to the school district. Okay? Now, the school district money is actually broken up. If you get to the school district level, it is further broken down into 3 governmental funds: a general fund, a capital projects fund, and a debt service fund. So as you can see up here, we're concentrating on the general fund, circling it with my cursor here, the general fund. So the general fund, what do we collect on their behalf? $2,250,000. So on the books and records of the general fund, we're going to credit the receivable for $2,250,000, but they only received $2,227,500. That'll be the debit to the cash. The $22,500 is going to be the collection fee expenditure. Okay. Obviously, we're going to do a similar journal entry for the school district capital projects fund and the school district debt service fund. Now let me show you the journal entry for the county. One more time before we get there, let me go back. Remember the county? $740,000 in county taxes were collected, plus an additional collection fee that was given to the county, for a total distribution of $779,940. So here it is, the county general fund, the county. Here's the breakup of the $740,000 collected, plus the collection fee is the total amount that is remitted to the county. Now, when you get to the county level, there are actually 4 funds where the taxes are going to be allocated. The General Fund, the Capital Projects Fund, the Debt Service Fund, and a Welfare Fund, which is most likely a special revenue type of fund. We're going to concentrate, and if you take a look at the top of the slide, the General Fund. So here's the General Fund. $540,000 in taxes were collected for the General Fund. That'll be the credit to the taxes receivable account. All right, but $579,940 was remitted to them, so that'll be the debit to the cash. You can see that we collected, or the county general fund received more than the receivable. That $39,940 represents the additional collection fee, and that will be a revenue. So as you can see, the collection fee is a revenue for the county, but is an expenditure for all of the other governments. All right, so that is the way it works, and hopefully you understand a custodial fund. In concept, it's very simple. Cash comes in and cash goes out. There's really no decisions that need to be made, really, from the custodial fund. All right, now, custodial funds are considered pass-throughs. However, if there is what we say administrative involvement or direct financial involvement, then the government is not going to use a custodial fund. They are most likely going to use what's probably a general fund in that case. All right, so administrative involvement. If the government needs to monitor recipients for compliance and requirements, if they have the ability to exercise discretion in allocating funds, clearly we've gone above and beyond cash in and cash out. Clearly that government has the ability to make decisions. In that case, we're not talking about a custodial fund. In this case, most likely the flow would go through a general fund, and revenue would be recorded when the money is received, and expenditures would be recorded when money is passed along to where it needs to go. All right, so be very careful with that. You have to determine if any administrative or direct financial involvement is incurring, and if so, there will be no custodial funds. Okay, that is the first half of this presentation dealing with custodial funds. Now let's turn the page to trust funds. So there are 3 types of trust funds, and I'm going to take you through some journal entries with an investment trust fund, and also take a look at a couple journal entries with a pension trust fund. But of course, we'll be discussing what a private purpose trust fund is as well. Okay, an investment trust fund. What an investment trust fund is when a whole bunch of governments get together and they decide to pool all of their investment monies and manage it in one way. People do this, or governments do this, really for efficiency purposes. This is the reason why you and I, as private investors, invest a lot of times in mutual funds. The reason we do that is because we know the mutual fund is being managed by somebody else. And we know we have monies to invest, but we don't have enough time or expertise to decide exactly what investments to buy and sell, and at what time to buy and sell. We basically leave it to the expertise of a mutual fund manager. Well, that would be the same reason why a bunch of governments get together and decide to pool investments. So let me give you an example. Let's say the city of Boca, heck, we can even say FAU, the city of Delray, the city of Deerfield, the city of Boynton, city of West Palm, city of Pompano, city of Fort Lauderdale. You get my point. A bunch of these governments get together and they all decide, hey, let's pool our investments and invest together. Well, that's a wonderful thing. Now, after that is decided that they would all get together and invest in one fund, or in one pool, investment pool, one of those governments needs to raise their hand and say, we will manage the money. All right? And let's just say, for argument's sake, the city of Boca Raton is the city that sticks their hand up and say, we'll do it, we'll volunteer to manage the money. Well, what that also entails is the city of Boca is going to have to account for the investment trust fund. All right, so hopefully you understand the picture. Now let's get into some dollars, and hopefully you will understand the journal entries. So here we are. We can see December 31st, or I should say January 10th, year 2020. There are 3 governments that get together and decide to pool their investments. We have the Drew County Debt Service Fund, the Town of Calvin Debt Service Fund, and the Town of Calvin Independent School District Capital Projects Fund. So we have these 3 governments getting together, and they all decided, let's pool our investments. They made this decision on January 10th, 2020. At this date, January 10th, 2020, the cumulative amount of the fair value of all of the investments in these 3 governments combined for $28,990. In addition to that fair value as of January 10th, 2020, there is $710,000 in accrued interest. All right, so January 10th, this is the magic date. This is the date that the fund is formed. The investment trust fund is formed. Now, as you can probably imagine, a trust fund is not going to record a journal entry for increases and decreases in the fair market values of their portfolio. They're not going to do that on a daily basis. Most likely they're going to do that on a monthly basis. Therefore, you would imagine that the last time the books and records of the city's investment portfolio was up to date would have been, and let me come back to the first column, December 31st, 2019, right? This would have been 10 days prior. So when these 3 governments transfer assets into the investment pool or the investment trust fund, they're going to be transferred out at the values as of December 31st, 19. And then, of course, any differences in fair value between December 31st, 19 and January 10th, 2020 are going to be recorded at that time, as well as the accrued interest. So let's take a look at an example. So the Drew County Debt Service Fund, that is one of the 3 governments that have decided to take their monies and pool it in the investment trust fund. Now, the Drew County Debt Service Fund, they are the ones, out of the 3 governments, they are the ones that raised their hand and volunteered and said, we will take care of the trust fund. We will account for the trust fund. So if we go back to Drew County's investments, what did Drew County Debt Service Fund's investments look like as of December 31st, 19? $1 million in cash, $13,373,000 in U.S. obligations. So those amounts, the $13,373,000 is going to come out of the investment balance of the Drew County Debt Service Fund. This $1 million in cash, I apologize, this should be in the credit column. All right, so cash balance is going down, and the investments for the U.S. agency obligations is going down. Now, in addition, the Drew County Debt Service Fund needs to record the $52,000 change in fair value. If you look at the December 31st, 19th value versus the January 10th, 2020 value, there is a $52,000 increase. Well, that $52,000 increase is going to be recorded for the first time. Here it is, $52,000. And lastly, there is accrued interest as of December 31st, or I should say from January 1st to January 10th. So 10 days worth of interest, $425,000. Boy, I wish somebody would give me $425,000 for 10 days of interest. That would be wonderful. But in any event, if you add up these four numbers, once again, this million should be over here on the credit side. Apologize for that typo. If you add them all up, the Drew County Debt Service Fund is going to have a new asset on their books, and it's going to be called Equity in Pooled Investments. This equity in pooled investments represents their portion of the investment pool. Okay, so that is an example of a journal entry that one of the participants would go through when they are transferring assets into an investment pool. Okay, so, and the other two participating governments do very similar journal entries. Now let's take a look at a journal entry for the actual trust fund, the investment trust fund. Okay, so here we saw the $14,850,000, all right? So that is one of the three governments, $14,850,000. Now, the town of Calvin and the Calvin School District, using the same logic I just explained to you with the Drew County, their portfolio balances that are going into the fund are $9.9 million for the town, $4,950,000 for the school district. All right, and all of the investments are going into the portfolio. All right, the trust fund, cash $1 million, T-notes $9,545,000, U.S. agency obligations, repurchase agreements. Now these numbers are coming from the January 10th column on the prior slide. And then, of course, the $710,000 of accrued interest. Let me just go back and show you. All right, so basically it's going to be all of the fair values as of January 10th plus the accrued interest. That's this last column down here. That is all going into the investment trust fund. Now, all the investments are out of the individual governments, and they are now pooled together in the investment trust fund, and here they are. Now, I need to explain something to you before we move on. You remember I explained to you, one of the governments needs to account for the trust fund. They are called the internal participant. All of the other governments would now be called the external participants. So the Drew County Debt Service Fund, they are the internal participant. So in the investment trust fund, that is going to be a liability called due to debt service fund. This amount, the due to in the trust fund, is always, 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 I can say that word a million times, that is always going to equal the equity and pooled investments on the actual, the other fund. In this case, it would be the debt service fund. Okay, $14,850,000, $14,850,000. That's the link between the trust fund and the debt service fund of Drew County. Now, all of the other governments or the external participants, the credit doesn't go to a liability, but the credit goes to an account called additions. And I know we said this earlier in the semester, but I will say it again. Trust funds do not use the terms revenues and expenses. They are going to use the terms additions and deductions in its place. And the reason for that is because this is truly not the government's revenue and expenses. They are just managing the money for somebody else. So the better terminology to use is additions and deductions. That's where the name comes from, additions. And we're going to have an additions account for each external participant. So we have an additions account for the town of Calvin, and we have an additions account for the Calvin School District. Okay, now the trust fund has been established. Now the trust fund is going to go to work, and the trust fund is hopefully going to earn money. And in this next journal entry, we see Three things going on. The first thing is there is a fourth government that wants to join the party. And this is going to be the Drew County Capital Projects Fund. Maybe the finance director of the Drew County Debt Service Fund, which was a participant in the pool already, maybe they went out to lunch with the director of the Capital Projects Fund. And the Capital Projects Fund said, "That is awesome. We want in." And so a fourth participant has joined the group, and they have decided to put $15 million in cash into the trust fund. So the first thing that's going on in this journal entry is the debit to cash and the credit to due to Capital Projects Fund of $15 million. They are a newly established participant. In addition to that, the U.S. agency obligations increased in value by $310,000. You can see the debit to the investment account. And the U.S. T-notes decreased in value by $10,000. And there is the $10,000 credit to reduce the investment account. So on a net basis, the investment portfolio, it went up $310,000, it went down $10,000, so it went up a net of $300,000. Well, that $300,000 increase in the portfolio is going to be allocated to all of the participants in the pool based on their ownership percentage at this moment in time. Well, we're not going to include the Capital Projects Fund because they just joined. But, and let me show you this. I'll come back, but I want to show you that the Debt Service Fund owns, well, maybe that's not the best way to do it. What you need to do is you need to come back here. Here it is. So you see this total, $14,850,000. Divide that by these three numbers combined. That gives you the ownership percentage of the debt service fund at this moment in time. The town of Calvin, $9,900,000. Divide that by the sum of these three numbers. That gives you their ownership percentage. And the school district, $4,950,000. Divide that by the sum of these three numbers, and that'll give you their ownership percentage. And so the $300,000 increase, if you do the percentages that I just explained to you on the prior slide, you will see that the debt service fund owns 50% of the pool at this moment in time. That is why they are allocated 50% of the increase. We will credit due to debt service fund. The town of Calvin, if you do the math, they actually owned 33% or 1/3 of the pool. And that's why they get $100,000, 100 out of the 300,000. And you can see the town of Calvin, they get the remainder, 50,000. The town of Calvin and the Calvin School District, they are external participants. That's why we credit the additions account. But the debt service fund, they are an internal participant. And by the way, at this moment in time, the Capital Projects Fund, because they are also part of Drew County, they are also going to be an internal participant. So out of the 4 participants in the pool, 2 are internal and 2 are external. Now, you remember the $710,000 in interest receivable at the end of January 10th? Well, that is being collected in addition to another $900,000 in earnings on the investment portfolio. So the trust fund is going to debit cash, credit the interest receivable, and credit the $900,000 to a temporary account called undistributed earnings. And then what the trust fund does is they take that undistributed earnings and they will debit it to zero it out in the next journal entry, and then they will allocate it based on the ownership percentages at this moment in time. At this moment in time, the investment portfolio is owned 3/9 of the debt service fund, 3/9 for the Capital Projects Fund, 2/9 from the town of Calvin, and 1/9 from the school district. Journal entry 4B. What I want to show you is not the trust fund, but let me show you an example. You see the debt service fund? They were just allocated $300,000 of the earnings. So guess what they're going to do? In the debt service fund, do you remember this account that we established called equity and pooled investments? Yeah, we did that way back, one of the first journal entries, when the money was coming out, or the portfolio was coming out of the debt service fund and into the portfolio. We used this account called equity and pooled investments. Well, here we go. Since they got an allocation of $300,000, that account will increase by $300,000. And the credit will go to the revenue account. And then we just go through it more and more. They invest, they allocate, they invest, they allocate. So getting back to the trust fund, their $450,000 increase in the portfolio. Debit investments, credit, change in fair value. They will then take this undistributed change in fair value, debit it, and they will allocate it among the investment portfolio participants based on their ownership percentage at the time. Okay, now the trust fund is receiving $720,000 in interest. Debit the receivable. Actually, they're not receiving it yet, but they are accruing for it. So we will debit the receivable and credit the undistributed earnings, and then we will take that undistributed earnings and allocate it based on the ownership percentages at this moment in time. Okay, so after all of that, here are the balances. You can see the debt service fund still owns 3/9 of the pool. The capital projects fund still owns 3/9 of the pool. The town of Calvin owns 2/9 of the pool, and the school district still owns 1/9 of the pool. And so all of our portfolio gains and losses and interest and dividends and whatnot, they will all be allocated based on these ownership percentages until there is a new participant coming in, or a new contribution coming in, or a withdrawal. If a new contribution comes in or there's a withdrawal out of the trust fund, we need to stop and we need to recalculate the ownership percentages. And that is going to happen here. You can see that the debt service fund decides, you know what, trust fund, thank you very much for helping us with our investing, but we need to make a large withdrawal. And that would make sense, right? Because you guys have studied debt service funds before in a prior lesson, so you know the whole objective of a debt service fund is to pay back principal and interest on long-term debt. So they're going to need cash. So this makes sense. So the debt service fund, they decided, hey, give me some cash. So the debt service fund debit cash, credit the equity and pooled investments, and obviously as the debt service fund is recording that journal entry, the trust fund is saying, sorry to see you dilute your investment portfolio, but we will give you the money, right? There's no obligation to keep it long term. So the debit is going to go due to debt service fund, and the credit will go to cash. All right, so after the withdrawal, like I said, we need to stop and we need to reallocate or recalculate the ownership percentages. And here they are. So the debt service fund, which used to own 33% of the pool, now owns 25% of the pool. The capital projects fund, which used to own 33% of the pool, now owns 37.5% of the pool, and so on and so forth. So with these new percentages, that's the percentages that will be used on a go-forward basis whenever we need to allocate gains and losses and whatnot, changes in the investment portfolio, until such time as we need to recalculate the ownership percentages again if there is a new contribution or a withdrawal out of somebody's account. All right, so that is an investment trust fund. Hopefully that makes sense. Here are the closing entries at the end of the year. We will close our additions accounts with debits, and then we will credit all of our equity accounts. In this case, the net position for the town of Calvin and the net position for the school district. Basically, as you can see, there's only equity for the external participants. As I said to you before, the internal participants are recorded with liabilities in the trust fund. All right, a private purpose trust fund. I won't go through any journal entries with you, but I do want to explain it to you. A private purpose trust fund is when a government partners with a private partner, whether that's an individual, whether that's a private company, whether it's a nonprofit company. But in any event, they partner with them to perform a purpose that is outside the scope of a public purpose. All right, and so they would account for it in what's known as a private purpose trust fund. Let me give you an example. Let's say that the government partners with a private entity to open up an after-school program, all right, for kids. Now, that is something that is good for the community, yes, but it's not necessarily something where public funds need to go towards that, right? You and I, as taxpayers, we're not paying the government to keep track of all the children in the community. Do we think it's a good cause? Well, yeah, we have a place, the students have a place to go after school and maybe get help with homework, or at least have a place to stay out of trouble. That we would all, most of us would think that's a good thing to do for the community, but it's not necessarily something that should be done with public funds. All right, that would be a reason why you would open up a private purpose trust fund. All right, now let's take a look at pensions. This is the last part of this particular lesson. There are two types of pensions. There is something called a defined contribution plan, and there is also another pension called a defined benefit plan. A defined contribution plan is like your 401k plan at work. The only thing that's definite is the contribution that's going into it. And at the end, when you're ready to take distributions out of the 401k plan, the only thing through its life that was defined or that was definite were the contributions that went into it, whether it was employee contributions or an employer contributions. And so whatever is there when you're ready to retire, whatever that balance is, you have to retire on it, whether it's $500,000 or $5 million or something in between. That is yours. It is a lump sum. You need to make it work until the day you die. That is a defined contribution plan. Some governments have defined contribution plans, but quite often a lot of governments have what's known as a defined benefit plan. And I have to be honest with you, government is like the last industry or the last sector that has defined benefit plans. Most private companies have gone away from this. A defined benefit plan is your traditional pension plan. If you think about older pension plans, you worked for a company for your career, and at the end of the career, you get a pension check for the rest of your life, whether you live for 2 more years after retirement or 50 years after retirement. You will get a pension check. So the definite is the benefit at the end. Now the difference is this: the defined contribution plan, the management responsibility is on the shoulders of the employee. That's you if you have a 401k plan. Versus a defined benefit plan, the financial responsibility to manage the funds is on the shoulders of the employer, in this case, the government. So the government, if they make a promise for a certain pension payment, and there's usually a formula to figure out what the pension payment is going to be to a particular retiree, they need to make sure, when I say they, the government needs to make sure there is enough money there to pay out these employees in their retirement. So a big difference between a defined contribution plan and a defined benefit plan. Here are some journal entries. So this is what a balance sheet would look like for a pension trust fund. You can see the assets, and you can see the largest assets are obviously in the investments, right? There's over almost $115 million in investments here out of $118 million in total assets. That makes sense. And then very small little liability, and the difference is the equity or the net position. All right, so how does this work? Let me show you the journal entries. So it's really the pension plan earning money in 3 ways. employee contributions, employer contributions, and of course investment earnings. So the first journal entry that you would typically see in a pension is some investment earnings, debit cash, credit interest receivable, or if it wasn't a receivable, we would credit the interest revenue, which we would most likely call an addition, right? Once again, we're going to use the terms additions and deductions. Now a new payroll comes along, and so the pension plan is going to receive contributions from the employer and contributions from the employees, also known as members. Debit cash, credit the additions. Now number 3, so now the pension plan is going to get a deduction. So some employees are now retiring, and they want to take these benefits out of the pension plan. So those would be the deductions for the annuity or the disability investments, and disability benefits, excuse me. Journal entry 4, we're paying the accounts payable that we recorded in journal entry 3, and then some more, of course. No big deal there. Journal entry 5, some employees actually terminated. So they did not vest. Vesting simply means they did not get to the point where they actually got to make, get to a point where they can actually get a benefit out of the pension plan. So all of their contributions that they put into the plan during the years are going to be refunded to them. So the pension plan would debit deductions, credit cash. Now the pension plan is going to earn a little bit more investment income, debit cash in the interest receivable, credit additions. They're going to make some investment changes. So they're going to invest in common stock. They will divest out of bonds. So they'll credit the investment for the bonds. And the difference between the two is in this case, a negative change in fair value. That will be a deduction. Journal entry 7, we're cashing out of commercial paper, debit cash, credit commercial paper, which is an investment. Journal entry 8, we are cashing out of our investment in common stock, debit cash, credit the investment. Journal entry 8B, we're buying new bonds and stocks, credit cash. So you see what's going on here. The employers make a contribution, the employees make a contribution, hopefully the portfolio makes some interest in dividends and some fair value changes, and then of course some deductions for benefit payments. And that is basically how a pension works. Here are the closing entries at the end of the year. We will close our additions with debits, we will close our deductions with credits, and the net amount goes to net position. All right, and the last thing I wanted to explain to you is something called a net pension liability. The net pension liability is the difference between a total pension liability and the net position of the pension trust fund. So the total pension liability is basically, we have to hire an actuary, but basically the actuary is going to determine if everyone, meaning every employee and every retiree, had to cash out right now and what their projected benefit payments for their lifespan would be. All right, that is called the total pension liability. That total pension liability is compared to the net position or the equity of the fund. The difference between the equity of the fund and the total pension liability is called a net pension liability. And that net pension liability is actually going to be a liability for the government at the government-wide statements. That is a net pension liability. All right. It could be a net pension asset as well if the equity of the fund is actually greater than the total pension liability. Okay. It represents, in this case, the net pension liability represents the employer's unfunded pension liability. All right. So that is something I want you to know as well.